Aman Chowhan joins us. Let's take our conversation forward. Aman, so nice to have you back. Thank you for joining us. As we unwind 2022, there is good and bad. We've done very well if you look at what has happening to world. But for equity investors, the returns have been in single digit, which means somewhere you've done pretty much in line with what the bond market has done this year. So what is in store for 2023?
23, I think first half, the next 3-4 months could be challenging. Post which I expect the markets to continue to do well, both on absolute as well as a relative basis. So double-digit returns current year 23 definitely looks on the cards because that is where the earnings growth also is headed, and we are not yet expensive. We are closer to the 10-year mean, so don't see any major reason why there could be a PE re-rating. In fact, if PE re-rates a bit, we can have a good mid-teen to high-teen returns also possible.
Why do you think next 3-4 months would be challenging? What are you worried about?
Globally, I think the worry right now is on the demand impact due to high inflation. So we are seeing consumption, consumer discretionary spend slowing down in US, slowing down in UK, Europe. So that's having an impact on the export growth for most of the companies out of India. We are also seeing rural slowdown in India. So it will take some time, a few months for that to stabilize. So these two things will keep the earnings growth on check. And at the same time, as we speak, there is a big mean reversion happening in the markets or in the corporate world. So the companies that benefited out of COVID are now giving away those benefits, and vice versa. Whoever lost margins are now recovering. So China is opening up. Supplies from China is going to resume, and so has been the demand. So IT companies, they had a good margin. Now the margin is giving up. At the same time, chemical companies, they enjoyed lower raw materials from China, which stopped due to COVID. Now again, they're going to get it. So they're going to improve on the margins. So it's been a mixed bag in the near term, more of mean reversion. And that's the reason I feel there is no major trigger in the market just to move away in the near term.
If China comes back, which it should, looking at they've already given a timeline on COVID reopening, could that pour cold water on all the inflation peak theory? Because inflation has peaked out minus China. When China comes back, that's the time you know that the wheel is moving in the. I mean, all the wheels are moving cohesively.
So what can happen is the commodity prices can move up, which is good for commodity companies, but not for inflation. But I believe the reported inflation numbers will continue to come down because that's calculated on a YY basis. It's more of a mathematical number. The inflation base right now is so high that even if there is a 10-15% commodity price inflation coming in, overall CPI WPI will not see a very big impact. So for markets which look at CPI WPI, that number will continue to be lower, and markets will continue to feel that we are closer to the peak of the interest rate hike cycle, both globally as well as in India. And that is something which bodes well for the markets. So, yeah, China opening up can have a commodity inflation, but overall, I feel markets will take it more positively.
Aman, hi there. Morning. So, in light of these concerns that you're flagging off, do you believe that the earnings growth as well is likely to take a hit for the year ahead?
Not really. As I mentioned, next 1-2 quarters seems to be challenging quarters on the earnings front, more so because of the mean revision which I mentioned. Post which I think the normal growth which India is seeing, both from the government spending levels, both from the consumer level, that should start to pick up. And hence, a double-digit earnings growth for 23 is definitely on the cards.
Given that the expectation largely is that we could see a smart credit boom take place in India, how do you believe one should position themselves, or what's the long-term outlook when it comes to banks and financials across the board?
The financials definitely are looking good because we are coming out of the COVID worries, and with GDP as well as the government spending looking up, credit growth is also in double digits, and that should continue. Most of the banks will see lower NPAs, will see lower provisioning, and hence the reported net profit growth is also going to be pretty strong. And valuations are not too worrying, except for the large few retail-based private banks which trade north of 2 to 3 times book. Most of the sector is closer to 1 time book, 1.5 time book, and hence there's enough scope for that also to get re-rated because most of these banks, the peak cycle will have anywhere between 15 to 18% ROE. From that perspective, financials, especially banks, are looking good. The larger NBFCs are looking good. Microfinance is one sub-segment that is also looking good for the next year.
Between Diwali and now, when we spoke about mid-tier banks, we spoke about railways as a theme. These sectors have done rather well. Have you added any new sectors? Have you added any new ideas? How many new stocks you've added, let's say, in last 1 month? How many stocks you've deleted largely because of valuations or your outlook towards the company changed?
I'll say 2-3 stocks we have exited completely, mainly because the outlook for the company has changed, not on mostly on the valuation front. And we would have added similarly 2-3 new names. Some names in the financial space, some names on the quasi-consumption space.
Why do you like NBFCs? NBFCs will always underperform when the liability cost is going higher. NBFCs always have an issue in generating more stronger NIMs when the liability cost and the fixed deposits are moving to banks in a rising interest rate regime.
So as I mentioned, the leaders in the NBFC is what we like, and these companies have a decently strong franchise. And this year is going to be the year where growth is going to matter, because not everyone will be able to grow based on the CASA and based on the liquidity you are able to garner will determine as to how fast you can grow. So the larger NBFCs I feel are well placed, because the market ultimately focus first is growth and second is NPA. So the top NBFCs can deliver both growth as well as they can manage the NPAs pretty well versus the other packs. So within NBFCs, I will restrict myself to the leaders, and there I don't see a challenge. Yeah, cost will go up, but they are able to pass on because they are operating in a space where banking is still not present. That is the reason they exist, right? So if you stick to the leaders within the NBFC space, I think there is still quite amount of valuation re-rating which can come in.
I mean, would you consciously keep on avoiding fintech stocks, or they're reaching their level where the surprises will be more and the negative news will be less? Are we reaching that point?
For fintechs, we are looking at few names which are either profitable or are expected to be profitable in the near term, which is in the next, say, 12 to 18 months. That is the space that we are looking at. We are not yet acted about anything, but now clearly it's time to look at them. So we consciously avoided it for the last 2 years, and hopefully in the next 3-6 months, we should get a good entry point in maybe 1 or 2 of names in that space.
What's the general consensus on betting on, the overall capex theme? Would it be just isolated to infrastructure? Would it or capital goods rather? Would it extend to infrastructure, defense, railways as well?
I think next 12 months for this space, the EPC cap goods space is looking very interesting, because post budget, I believe the government spend should start to pick up in ahead of the central elections, and that is the time when most of the order books, most of the tendering will happen. And that is something that's going to be very exciting. So already these companies are doing well. They have a decent order book, and with the government spending likely to accelerate big time over the next 12 months, this space definitely looks interesting. And the private capex continues. So both oil and gas, metals, electronics manufacturing, assembling, we are seeing good amount of on-ground capex activity. Plus, the government capex is also going to come in. So definitely, this would be one of my, so you can say, top sectoral picks for the next 12 months.
Okay, let's talk about the underperformers of this year, Aman, and that has been IT as well as pharma. Both of those indices have managed to disappoint this year. Do you think think the things will shape up differently in 2023?
For IT, I think they could be market performers, or they could even outperform the market. Pharma could be market performer, because pharma is still reeling under high COVID base plus margin pressures in the US and the export market. For IT, it was more of a PE compression. Companies were trading at 40 Ps, which has come down to 20 P. Growth is still intact, bearing a few margin pressures here and there. But attrition cooling off, I think the worst on the margin front for IT companies are also behind us. So over the next 2-3 quarters, I think the IT should also start to pick up. And hence, I feel IT can definitely outperform this year. Pharma could be more of a market performer for 23.
Okay, and Aman, what about the entire real estate and real estate and cement play? Would you rather play it with the real estate players? Would you look at home building improvement space, consumer discretionary, durable, etc.?
So we don't have any direct real estate company in our portfolio, then we play it indirectly via cement and the building materials segment. Cement, I think 2Q was the worst quarter. 3Q onwards, from the current quarter, we'll see improvement. 4Q is going to be good. In the near term, cement definitely looks good because of the low base and because of the margin headwinds that they were facing is now going away. For building materials, it's been a mixed bag. Some segments have done well. Rural focused companies have not been doing so well because of the slowdown there. So one needs to be you can say you need to be selective as far as the building material space is concerned. But the outlook looks definitely good. In fact, I was reading a news article today morning that last year has been the record housing sales for the past several years in the top metro cities. This trend we expect to continue. A slight increase in, you can say, housing loan rates, I don't think is going to have a major detrimental impact on the demand. The demand is genuine in India. It's highly underpenetrated. Everyone around would want to upgrade the housing. So this is a secular theme for the next multiple years. So demand is there. Within that demand, which companies are able to handle their profitability, the competitive intensity would turn out to be the winners.
Okay, Aman, really appreciate your time. Glad you could join us and best wishes for a wonderful 2023.
Sure. Thanks for hosting me.